Crypto can look crazy. Green candles one day, red the next. In this video, you'll learn how to invest safely, the exact steps, pros and cons, and a simple plan you can follow. Cryptocurrency runs on a blockchain, a public ledger kept by thousands of computers. You control assets with a private key. Lose that key, lose access. Welcome to the world of cryptocurrency, a landscape filled with incredible opportunity and significant risk. On one hand, you have unparalleled access. The market never sleeps, operating 24/7, which means you can trade and invest on your schedule, not Wall Street's. You can also send value across the globe in minutes, bypassing slow and expensive traditional banking systems. It's a powerful tool for borderless transactions. But with this power comes volatility. It's not uncommon for major cryptocurrencies to swing 10 or even 20% in a single day. This can be thrilling, but also financially devastating if you're unprepared. Beyond market swings, there's a real security risk. Exchanges, the platforms where you buy and sell, can be targets for sophisticated hackers. To navigate this exciting but treacherous terrain, you need a solid plan. We're going to build that plan together, starting with the most important first step: getting started safely. Your journey begins with choosing a cryptocurrency exchange. Think of this as your home base for trading. But not all exchanges are created equal. Your absolute priority should be selecting a regulated exchange, such as Coinbase, Kraken, or Gemini, depending on your region. Regulation means the exchange is required to comply with financial laws, which often include security standards and consumer protections. It's your first line of defense. When comparing these platforms, look beyond the flashy ads. Investigate their security history. Have they had major breaches? What measures do they have in place, like cold storage for funds? Also, consider the user interface. Is it clean and easy for a beginner to understand, or is it a complex dashboard built for professional traders? Finally, check which cryptocurrencies they offer and what their customer support is like. You want an exchange that will be there to help if you run into trouble. Once you've chosen an exchange, it's time to create and secure your account. The sign-up process will involve something called KYC, or Know Your Customer. You'll need to provide personal information and upload a government-issued ID. This isn't the exchange being nosy, it's a legal requirement to prevent fraud and money laundering, just like opening a bank account. Now for the single most important security step: setting up two-factor authentication, or 2FA. But listen closely. You must use an authenticator app like Google Authenticator or Authy. Do not use SMS-based 2FA. Why? Hackers can use techniques like SIM swapping to intercept your text messages and gain access to your accounts. An authenticator app generates a secure, time-sensitive code directly on your device, making it virtually immune to this kind of attack. This is not optional. It's essential for protecting your funds. Finally, let's talk about the cost of doing business. Fees. They can eat into your profits if you don't understand them. You'll primarily encounter two types. First are trading fees, typically a percentage of your transaction, ranging from 0.1% to over 1.5%. Many exchanges use a maker-taker model, where you pay a lower fee if you make liquidity by placing an order that doesn't fill instantly. The second, often hidden cost, is the spread. This is the difference between the buy price and the sell price of a crypto asset at any given moment. To minimize these costs, avoid the tempting instant buy or market order buttons. Instead, learn to use limit orders. A limit order lets you set the exact price at which you want to buy or sell. It might not execute immediately, but it gives you control and often results in significantly lower fees. Mastering this one simple trick can save you a substantial amount of money over time. Welcome to the most crucial part of your crypto journey: building a smart investment strategy and locking down your security. Getting these two things right from the start is the difference between confidently building wealth and anxiously gambling. It's not about finding a secret coin. It's about creating a disciplined plan and a digital fortress to protect your assets. Let's build that foundation, step by step. First, let's talk about where your crypto lives. When you buy on an exchange, it's incredibly convenient. But here's the catch. The exchange holds the private keys for you. This is known as custodial storage. You're trusting them completely. You've probably heard the phrase, "not your keys, not your coins." This isn't just a saying, it's a fundamental principle. History has shown that even the biggest exchanges can fail, get hacked, or freeze withdrawals, leaving users unable to access their funds. While they are great for buying and selling, they are not ideal for long-term storage. The solution is self-custody, and the gold standard for this is a hardware wallet, also known as a cold wallet. Think of it as your personal offline vault for your crypto. This small physical device generates and stores your private keys completely offline, away from hackers and online threats. When you want to send crypto, you connect the device to your computer or phone, and the transaction is signed internally on the device itself. Your keys never ever touch the internet. This single step puts you in complete control. The best practice is a simple two-step process. Use the exchange as your on-ramp. Buy your Bitcoin, Ethereum, or other assets there. Then, once the purchase is complete, immediately withdraw those assets to your own hardware wallet for secure, long-term holding. This gives you the best of both worlds, the convenience of the exchange and the security of self-custody. Now, what should you buy? It's easy to get overwhelmed by thousands of different coins. The most durable strategy, especially for beginners, is to keep it simple. Your portfolio should have a solid core. For the vast majority of investors, this core is made up of Bitcoin and Ethereum. Bitcoin is increasingly seen as a digital store of value, a digital gold that is decentralized and has a fixed supply. Ethereum, on the other hand, is the foundational layer for a new digital economy, powering decentralized finance, DeFi, NFTs, and thousands of other applications. A sensible allocation is to dedicate 80 to 90% of your portfolio to this core of Bitcoin and Ethereum. This provides a stable foundation. The remaining 10 to 20% can be your explore allocation. This is where you can invest smaller amounts into other projects you've thoroughly researched and believe in. These are higher risk, but can offer higher rewards. The key is research. Don't just buy something because it's trending on social media. Understand its purpose, the team behind it, and its long-term potential. Remember, you don't need 50 different coins to be successful. A focused, well-understood portfolio is far more powerful. Next, how should you invest? The biggest enemy to any investor is emotion, fear, and greed. The best way to defeat emotion is with a system. The most proven system is dollar cost averaging, or DCA. Instead of trying to time the market and buy the perfect bottom, which is nearly impossible, you commit to investing a fixed amount of money at regular intervals, no matter what the price is. For example, you decide to invest $50 every single Friday. When the price is high, your $50 buys fewer coins. When the price is low, your $50 buys more coins. Over time, this averages out your purchase price and smooths out the bumps from volatility. Nearly every major exchange allows you to automate this. Set up a recurring buy and let the system do the work. This removes emotion and ensures you are consistently building your position. Then, once a month or once a quarter, you can review your portfolio to see if you need to rebalance back to your target allocations. Now let's talk security. This is non-negotiable. Your strategy is worthless if your assets aren't secure. Your first line of defense is two-factor authentication, or 2FA. But not all 2FA is equal. Avoid using SMS-based 2FA, as it's vulnerable to SIM swap attacks. Instead, always use an authenticator app like Google Authenticator or Authy. This generates a time-sensitive code on your device, providing a much stronger layer of security for your exchange accounts. Your second line of defense is strong, unique passwords. Never reuse passwords across different websites, especially not your crypto exchanges. A password manager is your best friend here. It will generate and securely store incredibly complex passwords for every single account you have. You only need to remember one master password. This simple habit can prevent a breach on one website from compromising your entire digital life. The final and most important piece of security is your seed phrase, also called a recovery phrase. When you set up a hardware wallet or any self-custody wallet, you'll be given a list of 12 or 24 words. This is the master key to all your crypto. Anyone who has this phrase can access your funds. You must protect it above all else. Write it down on paper, or even better, stamp it into a piece of metal. Never ever store your seed phrase digitally. Do not take a photo of it, do not save it in a text file, and do not store it in a password manager or in the cloud. It must remain completely offline. Store your physical backup in a secure private location, like a fireproof safe. For ultimate protection, create 2 copies and store them in 2 different secure geographic locations. This protects you against disasters like a fire or flood. Finally, let's secure your transactions. Crypto transactions are irreversible. If you send funds to the wrong address, they are gone forever. That's why you must always do a test transaction first. Before sending a large amount, send a very small amount, just $1 or $2, to the new address. Then go to your receiving wallet or use a Block Explorer to verify that the small amount has arrived safely. Only after you have confirmed its arrival should you send the rest of your funds. And one last critical detail: always double-check the network. When you withdraw from an exchange, you'll need to select a blockchain network. Sending a coin on the wrong network is another common way funds are lost forever. For example, if you're sending ETH to your hardware wallet, you must select the Ethereum or ERC20 network. If you accidentally select the BNB chain, your ETH will be lost. Always verify that the withdrawal network on the exchange matches the receiving network of your wallet. Take your time with every single transaction. A few extra seconds of diligence can save you from a catastrophic mistake. Welcome to the final and perhaps most crucial part of your crypto foundation: advanced strategies for staying profitable and safe. We've covered the how, now let's master the what's next. These aren't just tips, they are the rules that separate seasoned investors from speculators. They're designed to protect your capital and your peace of mind. The single biggest challenge in any market is emotion. Fear and greed can drive you to buy at the top and sell at the bottom. The antidote is a plan. You must decide your rules for buying, selling, and taking profit. You ever click the buy button? A written plan is your anchor in a sea of volatility. It turns emotional decisions into logical, predetermined actions. One of the most important rules is to take profits. Gains are just numbers on a screen until you sell. A simple but effective strategy is to sell a portion when an asset hits a preset target. For example, if a coin goes up 50%, consider selling 10 to 25%. This locks in some profit, reduces your initial investment risk, and gives you capital to reinvest elsewhere. Let's walk through that. You invest $1,000. The price increases by 50%, so your investment is now worth $1,500. You sell 25% of your holding, which is $375. Now, you have your $375 back in cash, and you still have $1,125 in the asset. You've completely recovered over a third of your initial capital, dramatically lowering your risk on the rest of the position. On a broader scale, manage your overall portfolio risk. A critical rule is to never keep more than 5 to 10% of your total net worth in any single cryptocurrency. No matter how promising a project seems, the crypto market is inherently unpredictable. Diversification is your ultimate defense. Your crypto holdings should be a calculated part of a larger, balanced financial picture. Just as you plan for profits, you must plan for losses. A stop loss is an order you place with an exchange to automatically sell a coin if it drops to a certain price. This acts as a safety net, protecting you from catastrophic losses if the market turns sharply against you. Setting a stop loss at 10 to 15% below your purchase price is a common strategy to cap your downside. Now, let's talk about security. The crypto space is full of opportunities, but it also attracts scammers. Your first line of defense is skepticism. Be immediately wary of any person or project promising guaranteed returns. Legitimate investments always involve risk, and anyone who tells you otherwise is not being honest. There is no free lunch, and there is certainly no guaranteed 10x. Be extremely cautious of unsolicited direct messages or DMs. Scammers will impersonate exchange support staff, project developers, or famous influencers. They'll offer to help you with a problem or invite you to a private sale. Their goal is to trick you into sharing your screen, clicking a malicious link, or revealing your private keys or seed phrase. Remember, official support will never DM you first. Phishing attacks are rampant. Scammers create fake websites that are nearly identical to real exchanges or wallets. They send you a link via email or social media, hoping you'll log in and steal your credentials. Always double-check the website URL. Look for subtle misspellings or strange domain endings. Better yet, never click links. Always navigate to financial sites by typing the address yourself or using a trusted bookmark. This brings us to the golden rule of crypto security. Never, ever under any circumstances share your seed phrase or private keys with anyone. And never, ever type them into a website or store them digitally. Not in a text file, not in your email drafts, not in a cloud drive. Write them down on paper and store them in a secure private location. Your seed phrase is the master key to all your crypto. Protect it. With security in mind, let's build a sensible starting portfolio. This is just an example to illustrate a balanced approach, not financial advice. We can think of it in 3 layers, balancing stability with growth potential. First, the foundation. About 70% of your portfolio in the blue chips, Bitcoin and Ethereum. These are the largest and most established networks. While still volatile compared to traditional assets, they are considered the bedrock of the crypto market, offering a degree of relative stability and long-term potential. Next, allocate around 20% to stablecoins, like USDC or USDT. These are your dry powder. They are pegged to a currency like the US dollar, so they don't fluctuate in price. This capital sits ready on the sidelines, allowing you to buy the dip, to purchase more core assets like Bitcoin when the market drops, without having to wait for a bank transfer. The final 10% can be for higher risk, higher reward projects, often called altcoins. This is the speculative part of your portfolio. The key word here is researched. Before investing, you should understand what the project does, who the team is, and what problem it solves. This is where you might find incredible growth, but you must also be prepared for the possibility of losing this portion of your investment. Now let's map this to a security timeline. In your first month, focus on the basics. Use a major regulated exchange and immediately enable two-factor authentication, or 2FA. Crucially, use an authenticator app like Google Authenticator or Authy, not SMS. SMS-based 2FA is vulnerable to SIM swapping attacks. An authenticator app is far more secure. Once your portfolio grows to a value you wouldn't be comfortable losing, perhaps by month 2 or 3, it's time to graduate to a hardware wallet. This device keeps your private keys completely offline, making it immune to online hacks. You'll transfer your long-term holds, like your Bitcoin and Ethereum, to this wallet for maximum security. This is called self-custody, and it's the ultimate goal for any serious investor. So, let's recap the core principles. 1. Have a plan. Define your rules for profit and loss before you invest. 2. Be paranoid. Question everything, trust no one with your keys, and practice safe browsing. 3. Build a balanced portfolio. Don't go all in on one moonshot. Layer your investments from stable to speculative. 4. Prioritize security. Use 2FA everywhere and move to self-custody for long-term holds. The world of crypto doesn't have to be chaotic and scary. By following a disciplined approach, using regulated platforms, dollar-cost averaging into strong assets, and taking control of your own security, you can navigate this exciting new frontier with confidence. You now have a robust framework for investing safely and intelligently. If this guide has helped you, please give this video a like and subscribe for more step-by-step crypto content. Hit the notification bell so you don't miss our next deep dive. Thanks for watching.